Hello my fellow investors and welcome to Invest Like a Guru and to our weekly update. Now, if you have been following both the market and our models, you know that it has been a bit of a rough time lately, and I'll have a look just late in the video about the different models. But first of all, let's have a quick look at the markets. Here we have the Nasdaq, and the Nasdaq has been beaten a lot down from the top here and to the absolute bottom. It was down 18%. Right now it's down 13-14%, and the question is it now that we will see the bottom here? Will we see a new bull market shooting up from here? Now, last week we had the FOMC meeting, and that was kind of a vague nothing burger. Powell, he said that pretty much what we expected to hear, but he didn't come up with any deadlines, any time limits, anything about their different initiatives to try to master that inflation. So the market was quite negative, but it bounced nicely up late here Thursday, Friday on the Nasdaq, and we can also see the S&P 500 here doing the exact same thing. Now the question is, was this it? Is this all the bear sellout that we are going to see, or is this just a so-called dead cat bounce before we will continue further down? Now, listening to our models, our risk on, risk off model, it is saying risk off as of today, meaning that all of the people that have the trial version or the paid version, they are getting a mail notification out saying, well, you need to go risk off now. They are, of course, getting notification as to what papers to put their money in. And it has been a bit annoying lately because we have been tipping from risk on to risk off and back a couple of times. But that is what the models sometimes do in these rare cases where we are seeing just the market balancing on an edge. So it might be risk off for a period now while the market tumbles down, or we might see the market shoot up and then we will probably go into risk on again, maybe losing a couple of percentages on the upturn. But that is what we actually like to do. We don't mind losing a couple of percentages of the uptick as long as we are out of the market when it really crashes, as it was in, for instance, 2020, 2018 and so on, where we actually made some decent money when the overall market was crashing. So this is it right now. We are seeing interest rates getting closer and closer from the shorter term to the longer term. I guess you already know this chart if you have been seeing some of our videos, but we can see the shorter term yields down here at 2 months, 6 months, 12 months and so on. They are accelerating upwards, whereas the 7, 10, 20 and 30 years up here, they're going pretty much sideways. So I've been talking about that in several videos about that potential inverted yield curve, but basically it just tells us that the interest rates here are going up due to the fund raising their interest rates, and these are staying stable or dropping a bit because people are buying long-term bonds to make to place the money in something a bit more certain and secure. So that's it. Let's have a look at the quick models here. Oh, I should mention that this week we will see some earnings, and I'm always looking at what will affect the market in the upcoming week. And there's no doubt that the earnings from the big players, the Google, AbbVie, Amazon, Ford, Starbucks and so on, they will definitely have an impact on the market, especially if they are way off either to the good or the bad side. And then, of course, we have on Friday, we have the non-farm payroll. And that is where we are seeing how many jobs have the US economy been able to produce. And people will be watching towards that on Friday, and also some of the job opening reports during the week here to see if there's any reason for Powell and Fed to raise the interest rates more than 3 times maybe. People are talking about maybe 4, maybe 5 rate hikes this year, but that is all speculative and rumors running around. So I am guessing that we're going to see a volatile time the next couple of weeks. If it'll be up or down, well, it's hard to say. Our models, as I say, is saying risk off, and if we are looking at the models, they have still taken a bit of a beating this year. The first month is pretty much the worst in the history of our models here, year to date on the weekly, 17.3%. Now, as I mentioned in many videos, I'm not personally using the weekly model. It simply doesn't give the stocks enough time really to move. So I am more into the quarterly and maybe the monthly. The first month in every quarter, they are the same, but now from tomorrow, the 1st of February, they will start to deviate, since the quarterly are staying in the same stocks for the entire quarter, and of course the monthly model won't. However, now that we are going risk off, it will be a bit different this time. Had we just been risk on in stocks, they would have just normally started to deviate. Right now, they are pretty much the same, going risk off, and then we will see what happens depending on how far this risk off period will last. But it is interesting times, and going into risk off, I am quite confident that that could be a good play for the upcoming weeks. Now, the monthly model is only, quote unquote, only down 13.5% for the year so far. And I'm also confident that we will gain that back over the year. But of course, it is a bit of a rough start here. The quarterly momentum is the same, since they run with the same stocks here for the first month. Now, the ETF strategy, that is the most conservative strategy. We can see that is only down 7.75% this year. Still a bit of a hard time for conservative strategy, but only about half the drawdown as we see on the momentum, the long monthly and quarterly momentum. Then we have the ultimate dual momentum, the strategy that we tested and found to perform better than the normal dual momentum model. It is still down 9.86% this year to date, so also a rough patch for that one. Basically, there are not many models that have gone completely unaffected through this January. It has been a tough time. Let's see where it turns from now. We are not trying to predict anything. We are simply just following our models as always. It has shown all through the years, both during our testing periods and during the last years of actual investing our own money into these models, that just following the models, even though it can be a bit tough sometimes when we see a drawdown, following the models is the right thing to do, at least for us, if you like an investment style where you don't get your emotions involved. That's all for now. I'll talk to you again during the week here with some research videos, and yeah, I'll see you later. Bye.